Imagine waking up tomorrow and seeing the price of gold smashing through yet another record, climbing higher while stocks stumble, currencies wobble, and headlines scream uncertainty. In that moment, you might wonder, did I miss my chance? Or is this just the beginning of something even bigger? That's the question millions of investors are wrestling with right now, because gold isn't just glimmering jewelry or a collector's item locked away in vaults. It's becoming one of the most hotly debated investments in the world. And if you're sitting in the United States, Canada, Australia, or the United Kingdom, you probably want to know whether buying gold today is a smart move or a mistake waiting to happen. Gold has been on an incredible run, reaching levels that few analysts thought possible just a few years ago. Central banks are scooping it up at record pace, pulling back from US treasuries and adding bullion to their reserves. Geopolitical tensions are rising, from trade disputes to conflicts that threaten global stability. Inflation has proven sticky, interest rates are shifting, and people are increasingly worried about the credibility of central banks. All of these factors converge into one key theme: when uncertainty rises, gold shines. And that's exactly what we're witnessing now. But let's take a step back. What actually makes gold so unique compared to other assets? Unlike stocks, it doesn't produce profits. Unlike bonds, it doesn't pay interest. Unlike real estate, it doesn't generate rental income. In fact, if you think about it from a purely utilitarian perspective, gold just sits there. But that's precisely the point. Its lack of dependence on a business model, a cash flow, or a political regime makes it the ultimate neutral asset. Gold has survived the collapse of empires, the rise and fall of currencies, and countless economic crises. People turn to it not because it produces, but because it protects. That protection, though, comes with nuance. You can't put all your money in gold and expect to retire comfortably. History shows us that over very long periods, equities, shares in businesses that actually produce value, outperform gold. Stocks compound, they grow, they pay dividends. Gold, in contrast, is more like an insurance policy. You don't buy fire insurance on your house expecting it to make you rich. You buy it so that if disaster strikes, you're not wiped out. Gold plays that exact role in a portfolio. It doesn't have to beat stocks or bonds. It just has to shield you when the world gets messy. So how much gold does it make sense to own? Financial advisors and wealth managers around the world debate this endlessly, but most converge around a reasonable range, somewhere between 5 and 10% of your portfolio. That amount is small enough that it won't drag down your long-term growth, but large enough to cushion you if markets spiral. Some more aggressive investors might go as high as 15%, but very few credible voices suggest more than that. Gold is a tool, not the whole toolbox. But what kind of returns can you realistically expect from gold? Historically, the long-term inflation-adjusted return of gold has hovered close to zero or slightly positive. That might sound disappointing compared to equities, which have delivered 6 to 7% above inflation over the last century. Yet in shorter windows, gold can surge dramatically. Over the past 2 decades, it has averaged around 8% annually. That's the paradox. It's a poor compounder, but a powerful performer in specific environments, especially when inflation rises or when confidence in financial systems weakens. Now here's where it gets especially interesting for today. Central banks, especially in emerging markets, are buying gold like never before. They're diversifying away from the US dollar, hedging against political risks, and securing reserves in something that can't be printed or sanctioned. That massive, consistent demand forms a kind of floor under the gold market. Add to that the surge in investment flows, exchange-traded funds, private vaulting services, digital gold platforms, and you get the recipe for continued upward pressure. If institutions keep allocating even small percentages of their vast portfolios to gold, the price can go much higher than most skeptics admit. For individuals in the US, Canada, Australia, and the UK, the big question is, what's the best way to buy? Physical gold is the most traditional option. Coins and bars offer tangible ownership, the comfort of holding something real in your hands. But physical gold comes with costs, premiums over spot prices, storage fees, and the risk of theft if you're not careful. It makes sense for people who want the security of knowing they have their wealth outside the financial system, but it's not always the most efficient. That's why many investors prefer gold ETFs, exchange-traded funds backed by bullion stored in vaults. They trade on stock exchanges like regular shares, giving you exposure to gold's price without the hassle of storage. They're liquid, cost-effective, and simple. In the US, the SPDR Gold Trust, known as GLD, is the biggest. In Canada, there's CGL. In Australia, the Perth Mint offers ETFs. In the UK, you'll find products listed on the London Stock Exchange. Each option gives you gold exposure while fitting seamlessly into a brokerage account. Then there are gold mining stocks and funds. These are more volatile than bullion because they combine 2 risk factors: the price of gold and the profitability of mining companies. If gold rises, mining shares often rise faster because higher prices can expand their profit margins. But if gold falls, or if a company faces production issues, labor strikes, or environmental hurdles, the stocks can crash. This makes miners more speculative. suited for investors who want leveraged exposure to the gold cycle rather than a steady hedge. In recent years, digital gold platforms have emerged too. Services like Bullion Vault in the UK or offerings from the Perth Mint in Australia let you buy fractional amounts of gold stored in secure vaults. These options are convenient, transparent, and often cheaper than traditional bullion dealers. They combine the tangibility of real gold with the ease of online access. For people who don't want to deal with physical delivery, but also don't trust purely paper claims, digital vaulting strikes a balance. So, should you buy gold right now at these lofty prices? That's the million-dollar question. If you think of gold as a short-term speculation, timing matters a lot. If you buy at a peak and sell in a dip, you can lose significantly. But if you think of gold as a strategic allocation, timing matters less. Buying gradually, in small amounts over time, a strategy known as dollar cost averaging, helps smooth out volatility and keeps you from making emotional mistakes. You don't need to perfectly predict the next move. You just need to ensure you're not overexposed. Here's an important mental model. Think of gold as an anchor, not a rocket ship. An anchor holds your portfolio steady when the storm hits. A rocket ship is what you hope your stocks will be, driving compounding growth. If you confuse the two, you set yourself up for disappointment. Don't buy gold expecting it to double your net worth in 5 years. Buy it expecting that if inflation spikes or the dollar falters or markets tumble, you'll have a shield. Now, let's look ahead. Analysts at major banks have started floating bold targets. $4,000 an ounce in the coming years, maybe even $5,000 if investor flows accelerate. Those numbers might sound extreme, but when you consider the trillions parked in government bonds and cash, even a tiny shift into gold could fuel massive moves. This isn't a prediction, but it's a scenario worth understanding. If confidence in central banks continues to erode, or if fiscal crises mount, investors could rush into assets perceived as safe, and gold is at the top of that list. At the same time, remember the cycles. Gold had an epic run in the late 1970s, then collapsed for 2 decades. It soared from 2001 to 2011, then fell nearly 40% by 2015. The current bull market has been powerful, but no trend lasts forever. Eventually, as inflation cools or interest rates stabilize or global tensions ease, gold could plateau or even decline. That's why balance is everything. Gold is not an all or nothing bet. It's a complement. If you're watching this in the US, you might be thinking about your 401k or IRA. Gold ETFs can fit into those accounts, giving you exposure in a tax-efficient way. In Canada, you can use your RRSP or TFSA to hold gold. ETFs. In Australia, self-managed super funds can allocate to Perth Mint products. In the UK, ISAs and SIPs often allow for gold exposure through listed funds. The point is, wherever you are, there are ways to integrate gold into your investment strategy without overcomplicating things. So let me circle back to that opening question. If gold is soaring, are you too late? The honest answer is no. Not if you're thinking about it the right way. You're not trying to chase the last 20% of a rally. You're trying to build a portfolio that can survive whatever the future throws at it. If gold goes higher, your hedge pays off. If it goes sideways, you're still fine because most of your wealth is compounding elsewhere. And if it falls, your limited allocation means you don't lose sleep. That's the rational way to think about it. Gold is timeless, but your financial goals are not. You want growth, income, and security. Gold only delivers on the last of those three. It's up to you to mix in the other ingredients. Stocks for growth, bonds for stability, maybe real estate for income. Together they form a portfolio built to last. Gold is your insurance policy, your anchor, your store of trust in a world where trust is often in short supply. So whether you hold it in coins tucked away in a safe, in ETFs traded daily on exchanges, in shares of mining companies, or in digital vaults accessible through an app, the key is moderation. Enough to matter, not enough to dominate. Enough to protect, not enough to dictate. That's the real secret to investing in gold. And now, as you think about your own investments, ask yourself, if the world got messy tomorrow, would you feel secure? If the answer is no, maybe it's time to consider how much gold belongs in your corner. Because the question isn't really, should you buy gold now? It's whether you'll wish you had when uncertainty strikes.